The 250-year money cycle. How global empires rise, fall, and how to protect your wealth. The illusion of unprecedented times. The greatest risks to your wealth don't come from events that are rare in human history. They come from events that simply haven't happened during your lifetime. When markets crash, currencies devalue, or global powers clash, we call them black swans or unprecedented crises. But if you look back over the last 500 years, you realize these aren't anomalies at all. They are regular, recurring stages of a macroeconomic cycle that repeats across empires. Over the past 5 centuries, every major global superpower, from the Dutch Empire in the 1600s to the British Empire in the 1800s to the United States today, has followed an almost identical 250-year pattern. They rise through productivity and sound money, peak through debt-fueled excess and reserve currency privilege, and eventually decline through massive money printing, internal division, and external conflict. In this 30-minute deep dive, we are breaking down the complete mechanics of the big cycle. We will look at why paper money inevitably gets devalued, how debt traps even the greatest empires, and, most importantly, the exact portfolio strategies you need to protect your purchasing power when the global order begins to shift. Let's get into it. The 8 vital signs of an empire. Before an empire can fall, it must rise. But how do we actually measure the strength of an economic superpower? Just as a physician checks vital signs like heart rate and blood pressure to judge a person's health, we can track 8 specific indicators across history. 1. Education and discipline. Not just technical knowledge, but character, civic trust, and work ethic. 2. Innovation and technology. Moving from copying basic tools to inventing the systems that shape the world. 3. Global competitiveness. The ability to produce high-value goods at attractive prices. 4. Economic output. Total productivity and real GDP growth. 5. Share of world trade. Dominating the shipping lanes and commercial corridors. 6. Military strength. Protecting those global trade routes from competitors. 7. Financial center dominance. Becoming the world hub for capital markets, like Amsterdam in the 1600s, London in the 1800s, and New York today. 8. Reserve currency status. The pinnacle of power, where global transactions and savings are conducted in your currency. These 8 forces do not appear all at once. They build sequentially in a virtuous cycle. Education leads to technological breakthroughs. Innovation drives trade. Expanding trade demands a powerful military, and trade dominance establishes the financial center and the reserve currency. But here is the critical lesson. They also decline in roughly the same sequence. The reserve currency is always the last pillar to fall, long after the foundational strengths, education, productivity, and fiscal discipline, have already started eroding. The rise phase, Dutch, British, and American blueprints. Let's examine how this played out across the last 3 global empires. In the 1600s, the Dutch rebelled against the Habsburg Empire. They were small, but exceptionally educated, organized, and inventive. They invented modern capitalism as we know it. They built ships that could sail around the globe with smaller crews, cutting shipping costs in half. They founded the Dutch East India Company, the first publicly traded company in the world. They created the Amsterdam Stock Exchange to pool savings into productive commercial ventures. Because the Dutch dominated world commerce, the Dutch guilder became the global medium of exchange and what many consider the first true global reserve currency. By the 1800s, the British followed the exact same playbook. With the Industrial Revolution, British manufacturing outpaced everyone. The British East India Company and London's capital markets took center stage, and the British pound sterling anchored world trade. Fast forward to 1944. After World War II, the Allied nations met at Bretton Woods. The United States held the majority of the world's gold reserves and produced over half of global industrial output. The U.S. dollar was formally crowned the world's leading reserve currency, pegged directly to gold at $35 per ounce. In every case, the rise was built on one simple foundation: producing more value than was consumed, inventing superior technology, and maintaining sound financial backing. The decline, debt defaults, and the devaluation playbook. Eventually, the debt becomes unpayable through standard taxation and production. Interest rates drop to zero, yet economic growth remains sluggish. The government faces a binary choice: outright default on its debt, or print new fiat currency to cover the shortfall. In 500 years of recorded economic history, governments always choose to print money. Look at the historical record. 1933, facing the Great Depression, President Franklin D. Roosevelt suspended the gold standard and outlawed private gold ownership to expand the money supply. 1971, the U.S. had issued far more paper dollar claims than had gold in Fort Knox. On August 15, 1971, President Nixon announced the temporary suspension of dollar-to-gold convertibility. In plain English, the U.S. defaulted on its gold promise, creating the purely fiat monetary system we live in today. 2008 and 2020. During the Great Financial Crisis and the pandemic lockdowns, central banks generated trillions in digital liquidity within months to stabilize markets. Out of roughly 750 currencies in circulation since the year 1700, less than 20% still exist today. Every single one that survived was significantly devalued. When new currency enters the system without a matching increase in economic productivity, the mathematical result is inevitable. The value of paper money plummets, while the nominal price of real assets, stocks, real estate, precious metals, and commodities surges. The investor's survival playbook. Understanding macro cycles is meaningless unless you translate it into practical portfolio defense. When a monetary system sits in the late stages of a big cycle, here is how you protect your capital. Vulnerable holdings/resilient assets. Excess paper cash, guaranteed real loss via inflation/productive equities, companies with real pricing power. Long-term fixed-rate bonds, vulnerable to currency debasement. Physical gold and commodities, historical monetary stores of value. Speculative, unproductive debt, high default vulnerability. Cash-flowing real estate, leveraged against fixed long-term debt. Key rules for individual financial defense. 1. Maintain personal balance sheet sovereignty. Eliminate high-interest consumer debt. Keep your living expenses below your income so you never become a foreseller during economic downturns. 2. Diversify across asset classes and jurisdictions. Don't keep 100% of your wealth tied to a single asset class or currency. 3. Invest in high-value, adaptable skills. Technological disruption and economic volatility reward those who continuously upgrade their earning power. Summary, reflection, and outro. The rise and fall of empires might feel abstract, but its effects land directly in our bank accounts, grocery bills, and investment portfolios. History shows that while the costumes, technologies, and names change, human nature and economic arithmetic remain constant. You cannot permanently borrow your way to prosperity. Printing currency creates inflation, not genuine wealth. Real economic security comes from disciplined productivity, continuous learning, and owning tangible, productive assets. As we look ahead at global trade shifts, technological changes, and evolving debt cycles, ask yourself, is your portfolio positioned for the previous decade or for the realities of the next one? Let me know your thoughts in the comments below. Which asset class do you rely on most to hedge against currency devaluation? If you found this breakdown valuable, please hit the like button, subscribe to the channel, and share this video with someone who wants to master the deeper rules of money. Thank you for watching, stay disciplined, and I will see you in the next video.